How is foreign assets taxed in Canada? In the past decade, Canadians have been among the most active buyers of properties in the United States. Florida, California, and Arizona have become preferred destinations for many Canadians trying to escape cold winters. However, the ownership of foreign properties often comes with added complexities and sometimes with hefty bills. Tax issues and estate planning are two important considerations when planning to buy or when already owning real properties in other countries, and in particular, in the United States. Canadians owning real properties abroad, whether for personal use or for investment purposes, must ensure to be fully compliant with their Canadian tax filing obligations. Canadian taxpayers may be required to complete a T1135 foreign income verification statement to disclose ownership of any foreign property if the cost of such property, either any individual property or in the aggregate, is greater than 100,000 Canadian dollars. In June of 2020, the Canadian Revenue Agency, CRA, announced a review of 6 years of real estate transactions in the U.S. The CRA has been trying to track down potential tax non-compliance from Canadian taxpayers related to U.S. properties. The focus has been on U.S. real estate and real property data where a Canadian resident was the owner or party to the purchase, sale, or transfer. The tax audit may include records on Canadian property transactions in the U.S., including municipal addresses, names of owners, square footage, sales histories, and property tax assessments. For years, the CRA has been trying to find ways to enforce tax rules applicable to assets owned abroad and to find potential hidden tax revenue. It is therefore important for Canadians who own properties in the U.S., or in other countries, to be complete and accurate when filing taxes or when making plans related to their estate to avoid penalties. Tax issues related to properties owned in other countries usually fall within one of the following categories: unreported foreign properties, unreported income, and unreported real estate sales. The CRA generally requires Canadian residents to file Form T1135 every year to report their foreign property if the total cost exceeds $100,000. There is, however, an exception for personal use property. Personal use property is generally defined as property owned by the taxpayer and used by the taxpayer, or by a related person, primarily for personal or enjoyment purposes. For example, a taxpayer is not required to report a house or a condo if it's solely used as a vacation home and it isn't rented out. But if the taxpayer owns foreign commercial property, or if the residential property is rented even just for part of the year with a reasonable expectation of profit, then the details of that property must be reported on the form. Failure to file Form T1135 or incomplete filing may lead to a costly fine, even when all the income from the foreign property has been reported. The penalty is $25 per day with a minimum penalty of $100 and a maximum penalty of $2,500. However, if the taxpayer has deliberately avoided filing the required form, the penalty increases to $500 per month for up to 24 months. Every Canadian resident is also required to report, and pay taxes on, their worldwide income. The income generated by foreign rental properties must be converted into Canadian currency and reported every year when filing a tax return. A taxpayer who owns a rental property in another country is allowed to deduct reasonable expenses incurred to earn the rental income. Further, a foreign tax credit may be available to ensure that the income from the property, which may also be taxable in the other jurisdiction, is not taxed twice. Failure to report the rental income from foreign properties may lead to a reassessment and tax penalties, even when the taxpayer has already paid taxes in the other country. Canadians owning properties abroad must also comply with the requirement to report the sale of the property. The CRA has been looking into sales of U.S. residential properties owned by Canadian taxpayers to ensure that any capital gain is reported when filing their Canadian tax returns. Where a Canadian who owns a house or a condo in the U.S. is a resident of Canada for tax purposes, the proceeds from the sale of the U.S. property are fully taxable as either income or capital gains, depending on the facts of the situation, subject to the U.S.-Canada tax treaty. A foreign tax credit is generally available for any U.S. tax paid, but the requirement to report the sale persists even when the taxes have been already paid in the other country. It is also possible for a Canadian to claim the principal residence exemption on a home located outside Canada. This may be the case where a Canadian resident taxpayer works in the U.S. for several months a year. Given that Canadian taxpayers are required to report the sale of their principal residence to the CRA, there is a requirement to report the sale of a U.S. principal residence to the CRA. A taxpayer who fails to report the sale can incur a maximum penalty of $8,000, along with disqualification of the property for the principal residence exemption. Taxpayers who have provided incomplete information, who have omitted information, or who have not filed Form T1135 may be able to come forward and correct their tax affairs through the Voluntary Disclosures Program. An application must be voluntary, complete, and involve the potential application of a penalty. Further, the application will be considered by the CRA only when the agency has no prior knowledge of the tax owing by the taxpayer. Penalties for failure to file Form T1135 can be high, and the disclosure program allows taxpayers to bring properties or transactions to the attention of the CRA and receive relief on the interest and penalties that they will have to pay. It should be noted that the voluntary disclosure program is complex and relief is not guaranteed.